Every great movement starts with a simple idea. For the Bogleheads, that idea came from one man who changed the world of investing forever. His name was John C. Bogle, the founder of Vanguard and the creator of the first index fund for ordinary people. Bogle believed that investing should be honest, simple, and for everyone. Not a game for Wall Street experts or speculators, but a steady path for ordinary people to build wealth with patience and discipline. Bogle's philosophy was rooted in one timeless principle. Do not try to outsmart the market. Instead, own the market. While most investors chase hot stocks, trends, and promises of quick returns, Bogle reminded us that time is our greatest ally. Markets may go up and down, but long-term, they reward those who stay invested. He encouraged people to trust in the power of compounding and low-cost investing, not in predictions or luck. The Bogleheads, a group of loyal followers inspired by his wisdom, built a community around these values. They believe that anyone, no matter their income or background, can achieve financial freedom by following a few simple rules. Spend less than you earn. Invest regularly. Keep costs low. Stay the course. And above all, focus on the long term, rather than short-term noise. This book, The Boglehead's Guide to Investing, is a map for that journey. It translates Bogle's principles into clear, actionable steps. From managing your lifestyle and choosing the right investments, to building a balanced portfolio and avoiding costly mistakes. Each chapter is designed to make you think like a true Boglehead. But before we dive into complex ideas like asset allocation or retirement planning, we must start with the foundation, the basics of successful investing. Because building wealth is not just about choosing the right stocks or funds. It begins with the way you live, save, and think about money. In the next part, Essentials of Successful Investing, we explore these fundamental lessons. You will learn how to create a healthy financial lifestyle, understand what you are buying, and take the right amount of risk. This is where your journey as a Boglehead truly begins. Part 1. Essentials of Successful Investing. Every strong building begins with a solid foundation. The same is true for wealth. Before you learn how to invest, you must first understand the principles that protect and grow your money over time. This part of the book is about those essentials, the mindset, habits, and core beliefs that separate successful investors from the rest. John Bogle often said that investing is not about brilliance, but about character. It is about having patience when others panic, discipline when others chase quick profits, and simplicity when others get lost in complexity. The goal is not to get rich overnight, but to grow steadily, year after year, by making wise decisions and avoiding foolish ones. In this section, the Bogleheads share the timeless lessons that help you think like a true investor. You will learn how to shape a lifestyle that supports your financial goals, how to invest regularly no matter the market's mood, and how to truly understand what you are buying. You will also see why inflation, risk, and diversification are not enemies, but essential parts of your strategy when handled wisely. This part is the heart of the Boglehead philosophy, focusing on what you can control. Your spending, your saving habits, your investment choices, and your emotions. These are the tools that build lasting wealth. So before you step into the world of funds, taxes, and portfolios, let us start where every investor should. With the foundation of a sound financial lifestyle. Because wealth does not begin with your first investment. It begins with how you live, how you save, and how you think about money. Now let us move to the first chapter. Choose a sound financial lifestyle. Here, you will discover why your daily financial choices matter more than any market movement, and how the way you live today shapes the freedom you will enjoy tomorrow. Chapter 1. Choose a sound financial lifestyle. The first and most powerful investment decision you will ever make is not which stock to buy or which fund to pick. It is the kind of lifestyle you choose to live. A sound financial lifestyle is the foundation on which all successful investing stands. Without it, no amount of clever strategies or market knowledge can save you. John Bogle believed that wealth building begins with habits, not high returns. The Boglehead philosophy teaches that before you even invest your first dollar, you must learn to live below your means. It is not about denying yourself joy. It is about creating freedom. Every dollar you save today is a small piece of your future independence. When you spend less than you earn, you gain control over your life. You can invest regularly, stay out of debt, and let your money work for you rather than against you. The modern world constantly tempts us to spend. Advertisements whisper that happiness lies in a bigger house, a faster car, or the newest gadget. But true wealth is not measured by possessions. It is measured by peace of mind. Bogleheads remind us that financial success comes from discipline, not display. The goal is not to impress others, but to secure your future. Living simply gives you the power to say no to unnecessary expenses and yes to opportunities that build real value. Creating a sound financial lifestyle begins with awareness. Track where your money goes. Many people are surprised to learn how much they waste on things that add little happiness. Once you see the truth of your spending habits, you can begin to make better choices. Save first and spend what is left, rather than spending first and saving what is left. Automate your savings so that it happens without thought. This turns discipline into habit, and habit into freedom. Debt is another enemy of the Boglehead way. Borrowing for education or a home can be sensible, but high-interest consumer debt drains your future earnings. It is like walking uphill while carrying a heavy stone. The sooner you pay it off, the faster you can move toward your goals. Avoiding unnecessary debt is a silent victory that builds strength over time. A sound lifestyle also includes protecting what you have. Emergencies are part of life. Medical bills, job loss, or sudden repairs can destroy progress if you are not prepared. That is why Bogleheads always keep an emergency fund, enough to cover several months of living expenses. It is not an investment for profit, but a shield that protects your peace of mind when life surprises you. The Boglehead lifestyle is not about frugality for its own sake. It is about balance and intention. Spend joyfully on things that truly matter: experiences, learning, family, or health. But spend consciously. Every financial choice should serve your long-term well-being, not short-term impulse. Once you adopt this mindset, investing becomes easy. You will no longer chase risky returns or panic in downturns, because your foundation is strong. You are not depending on luck or timing. You are depending on discipline and time. This is the secret of the Boglehead investor: not to be richer than others, but to be wiser with what they have. By choosing a sound financial lifestyle, you prepare yourself for every step ahead. You build stability, confidence, and a clear purpose. This lifestyle becomes your anchor in a noisy world of greed and fear. And once your financial habits are in place, you are ready for the next step: learning how to make your money grow. In the next chapter, Start Early and Invest Regularly, you will discover why time is the most powerful force in investing. You will see how small, consistent actions can turn modest savings into a lifetime of wealth, and how starting today is the greatest advantage any investor can ever have. Chapter 2: Start Early and Invest Regularly. Time is the investor's most powerful ally. John Bogle often reminded people that the earlier you start, the greater your advantage. This is not because early investors are smarter or luckier, but because of the magic of compounding. Compounding works silently and steadily. Every dollar you invest earns returns, and those returns earn more returns over time. The longer your money has to grow, the more powerful this effect becomes. Even small amounts invested consistently can grow into a significant fortune over decades. Starting early is not only about building wealth, it also reduces stress and risk. When you begin young, you have time to recover from mistakes and market downturns. You can take a long-term view, ignore short-term noise, and stay calm when others panic. Waiting too long to start investing puts enormous pressure on your future. You may feel forced to take higher risks or make desperate moves to catch up. Early investing gives freedom. It turns time into your partner rather than your enemy. Regular investing is just as important as starting early. Markets move up and down unpredictably. Trying to time the market is a gamble. often costing more than it gains. The Boglehead approach is simple. Invest a fixed amount regularly, regardless of market conditions. This strategy, often called dollar-cost averaging, buys more shares when prices are low and fewer shares when prices are high. Over time, it smooths out volatility and reduces the risk of making costly mistakes. Consistency beats brilliance. Many people wait for the perfect moment to invest, thinking they need insider knowledge or a market crystal ball. But the perfect moment rarely comes. Those who invest steadily, month after month, year after year, almost always outperform those who wait. Small, consistent contributions build habits. Habits build momentum. Momentum builds wealth. Starting early also allows you to take advantage of tax-advantaged accounts. Retirement plans, 401ks, IRAs, and other vehicles grow more effectively over time because of tax deferral and compounding. Even modest contributions made early can grow much larger than late, aggressive investing. The Boglehead principle is clear. Invest as much as you reasonably can, as soon as you can, and do it regularly. It is not only about money. Starting early teaches discipline, patience, and perspective. It encourages you to make financial decisions calmly, without the pressure of catching up. It turns investing from a stressful chore into a natural part of life. You learn that wealth is not about luck, timing, or genius. It is about commitment, consistency, and respect for the power of time. The next step, after starting early and investing regularly, is knowing what you are buying. In the next chapter, Know What You're Buying, you will learn why understanding your investments is more important than chasing the latest trends. You will discover how choosing the right investments protects your future and keeps you aligned with the Boglehead philosophy of simplicity, low cost, and long-term growth. Chapter 3. Know What You're Buying. Investing without understanding your investments is like sailing without a map. You may move, but you won't know if you're heading toward your destination. John Bogle often emphasized that clarity and knowledge are more important than cleverness or luck. Every investor must ask a simple question before committing money. What exactly am I buying, and why? Many people invest based on excitement or advice without understanding the underlying assets. Stocks sound glamorous, bonds feel safe, and mutual funds promise diversification. But each investment carries its own risks, costs, and behavior in different market conditions. Knowing what you are buying means understanding the purpose of each investment in your portfolio, the fees involved, and how it behaves over time. It also means knowing what you are not buying. Avoiding high-cost products or speculative instruments that do not align with your long-term goals. Bogleheads believe in simplicity. The most effective investments are often the simplest. Index funds, which mirror the performance of entire markets, are preferred because they are transparent, low-cost, and predictable. You are not betting on a single company or trying to outsmart others. You are buying a broad slice of the economy, participating in growth over time. This clarity makes it easier to stay invested, even when markets fluctuate. Understanding your investments also reduces emotional mistakes. Fear and greed drive many investors to buy high and sell low. When you know exactly what you own, why you own it, and how it fits into your plan, you are less likely to panic in downturns or chase trends in booms. Knowledge becomes a shield against impulsive decisions, protecting your long-term wealth. Bogleheads also emphasize fees. Every extra percentage point of cost erodes returns over decades. A high-fee fund may promise fancy management, but history shows that lower-cost options outperform most managed funds over time. Knowing what you are buying means understanding these costs and choosing investments that maximize what you keep rather than what others take. Another aspect of knowing your investments is understanding risk. Different assets behave differently during market cycles. Stocks may provide growth, but they fluctuate. Bonds may offer stability, but their returns may be lower. By understanding the characteristics of each investment, you can construct a portfolio that aligns with your goals, risk tolerance, and time horizon. Finally, knowing what you are buying means embracing patience. Investments are not instant money machines. They grow gradually, quietly compounding your wealth while you focus on living wisely. There is no shortcut, only consistent, informed action. Once you understand your investments, the next challenge is protecting them from forces that silently erode your wealth. In the next chapter, Preserve Your Buying Power with Inflation-Protected Bonds, you will learn how to shield your money from inflation, ensuring that your future purchasing power remains strong while your portfolio continues to grow. Chapter 4. Preserve Your Buying Power with Inflation-Protected Bonds. Even the best investments can fail if they do not protect you from a silent thief called inflation. Inflation slowly erodes the value of money over time. $100 today may not buy the same things 10 or 20 years from now. For investors who ignore this, it is like running on a treadmill while the cost of living keeps rising. No matter how fast you run, your future purchasing power diminishes. John Bogle and the Bogleheads stress that preserving your buying power is as important as growing your wealth. It is not enough to earn high returns. If inflation eats away your gains, your wealth does not improve in real terms. That is why a portion of every thoughtful portfolio should focus on inflation protection, ensuring that your money maintains its value over the long term. One of the simplest and most effective ways to do this is through Treasury inflation-protected securities, or TIPS. These are government bonds specifically designed to rise in value with inflation. Unlike ordinary bonds, whose fixed payments lose value in a rising cost environment, TIPS adjust their principal based on the inflation rate. This provides a shield against the hidden erosion of your wealth and offers peace of mind. Inflation protection is not just for retirees or cautious investors. Anyone with long-term goals benefits. Even small portfolios can suffer significant erosion if inflation is ignored. While stocks generally outpace inflation over decades, they come with volatility. TIPS offer stability and a reliable complement to growth assets. They help balance risk and maintain the real value of your investments. Understanding this principle also reinforces the Boglehead philosophy of planning and foresight. Investing is not just about chasing gains. It is about protecting what you already have while steadily building for the future. A portfolio without inflation protection may grow on paper, but in reality, the purchasing power of those gains could shrink. Inflation protection ensures that your growth is meaningful, not illusory. Choosing the right mix of assets, including inflation-protected bonds, requires thought and discipline. Younger investors may allocate a smaller portion to TIPS, focusing on growth while gradually increasing protection as they approach retirement. Older investors prioritize preservation and stability. The key is aligning your portfolio with your time horizon, risk tolerance, and ultimate goals. Bogleheads also remind us that inflation protection does not have to be complex or expensive. The goal is not to eliminate risk entirely, but to reduce it intelligently. By combining growth investments like stocks with protection against inflation, you create a balanced approach that allows your wealth to grow while maintaining its real value. Once your money is protected from inflation, the next important consideration is risk itself. How much can you safely endure, and how much is too much? In the next chapter, How Much Risk Should You Take?, you will learn how to assess your personal tolerance for market ups and downs, and how to construct a portfolio that lets you sleep peacefully while still pursuing growth. Chapter 5. How much risk should you take? Investing always comes with risk. There is no growth without it, and no reward without exposure to the ups and downs of the market. But risk is not the enemy, it is a tool. The challenge is knowing how much risk is appropriate for you, your goals, and your comfort level. John Bogle often reminded investors that the question is not whether to take risk, but how to manage it wisely. Every investor has a unique tolerance for risk. Some can watch the stock market drop 20% without losing sleep, while others panic at small fluctuations. Understanding your emotional response to market volatility is crucial. If you choose investments that make you anxious, you are more likely to sell at the wrong time. The best strategy is one that fits both your financial needs and your temperament. Peace of mind is as important as potential returns. Risk comes in many forms. Market risk, the day-to-day ups and downs of stocks and bonds, is the most obvious. But there are also inflation risk, interest rate risk, and credit risk. Each affects your portfolio differently. Bogleheads approach risk by focusing on what they can control: diversification, asset allocation, and low costs. While you cannot predict the market, you can manage your exposure to its swings and protect your long-term goals. One key lesson is that risk and reward are linked. Higher returns usually come with higher volatility, but chasing maximum returns can backfire if it forces you to make emotional decisions. The Boglehead approach emphasizes balance. Take enough risk to achieve growth, but not so much that you compromise your ability to stay invested during market declines. Diversification is the primary tool for managing risk. By spreading investments across different asset classes, industries, and regions, you reduce the impact of any single event on your portfolio. Risk cannot be eliminated, but it can be reduced to manageable levels. Understanding the relationship between risk and return helps you make choices that align with your goals and your comfort level. Another important principle is time horizon. Younger investors can afford more market risk because they have decades to recover from downturns. Older investors approaching retirement need more stability to protect accumulated wealth. Aligning risk with your timeline ensures that your portfolio can weather storms without forcing premature decisions. Finally, risk management is not a one-time decision. Life changes, markets evolve, and personal goals shift. Regularly reviewing your portfolio, reassessing your tolerance, and adjusting allocations keeps risk in check and ensures your plan remains aligned with your objectives. Once you understand your personal risk threshold, the next step is learning how to manage it effectively through one of the most powerful tools in investing: diversification. In the next chapter, diversify. Diversify. You will discover how spreading your investments across multiple assets can protect your wealth, reduce anxiety, and improve long-term returns. Chapter 6. Diversify. If risk is unavoidable, the Boglehead answer is simple. Do not put all your eggs in one basket. Diversification is the cornerstone of long-term investing. John Bogle repeatedly emphasized that spreading your investments across different assets reduces the impact of any single loss while still allowing your portfolio to grow. It is not about avoiding risk entirely. It is about managing it intelligently. Diversification works because different investments respond differently to economic changes. Stocks, bonds, and cash each behave in unique ways. Even within stocks, industries and regions move independently. When one asset struggles, another may perform well, smoothing the overall results of your portfolio. This balance allows you to stay invested without panic during market swings. The Boglehead approach focuses on broad diversification. Instead of picking individual stocks or trying to time sectors, investors choose index funds that cover entire markets. This simple strategy captures the growth of the economy while avoiding the high costs and risks of picking winners and losers. For example, a total stock market index fund spreads your investment across hundreds or even thousands of companies. Combine it with bond funds for stability, and you have a resilient portfolio that can weather almost any market condition. Geographic diversification is also crucial. Investing solely in your home country may expose you to local economic problems, political instability, or currency fluctuations. Global diversification allows you to benefit from growth in multiple regions, reducing reliance on any single economy. While international markets may have different risks, their inclusion balances your portfolio and opens new opportunities for growth. Another form of diversification comes from asset types. Stocks provide growth, bonds offer stability, and cash ensures liquidity. Within these categories, there are variations: government bonds, corporate bonds, real estate funds, and more. Each behaves differently under economic conditions. By combining them thoughtfully, you lower the probability of catastrophic loss while maintaining growth potential. Diversification also protects your emotions. Investors who concentrate their money in one stock or sector often experience extreme stress during downturns. Diversified portfolios reduce the likelihood of panic selling, keeping your long-term plan intact. Staying invested during turbulence is one of the most important advantages you can have in building wealth. It is important to remember that diversification is not static. Markets evolve, and your portfolio must be monitored and adjusted periodically. Rebalancing ensures that your original allocation aligns with your risk tolerance and goals, preventing overexposure to any single asset class. In essence, diversification is not complicated. It is disciplined. It allows you to participate in growth, protect against loss, and maintain peace of mind. By spreading your investments thoughtfully, you give yourself the freedom to stay the course and let time work in your favor. Once you understand the power of diversification, the next step is learning how external forces, like brokers and fees, can quietly erode your returns. In the next part, constructing your portfolio, you will see why keeping costs low and avoiding unnecessary intermediaries is as important as choosing the right assets. Part 2. Constructing your portfolio. Once you have mastered the essentials of successful investing, living within your means, starting early, understanding your investments, protecting against inflation, and managing risk, it is time to move from theory to practice. Part 2 of this book focuses on the practical steps of constructing a portfolio that reflects your goals, risk tolerance, and long-term plan. This is where strategy meets execution. Building a portfolio is not about chasing the latest hot stocks, complex schemes, or expensive financial advice. It is about creating a plan that is simple, disciplined, and aligned with your objectives. The Boglehead approach emphasizes that the investor controls what matters most: costs, asset allocation, diversification, and taxes. Every choice you make shapes the potential growth and security of your portfolio over decades. This part of the book examines the tools, strategies, and decisions that turn your saving and investing habits into real wealth. You will learn how to avoid hidden costs, choose the right funds, and construct a balanced mix of assets that works for your unique situation. You will also discover the subtle traps that brokers and advisors may present, and how to navigate them wisely. Constructing a portfolio is also about discipline and simplicity. Complexity can be seductive, but it often leads to confusion, mistakes, and higher costs. The Boglehead principle is to focus on the essentials. A well-diversified, low-cost portfolio that reflects your risk tolerance and grows steadily over time. This approach reduces stress and keeps you on course, even when markets are volatile. As we move into this section, remember that a portfolio is not just a collection of funds or stocks. It is the practical expression of your financial lifestyle, your risk tolerance, and your long-term goals. Every choice, from the type of fund to the mix of assets, should serve a clear purpose. The next chapter, The Enemy is Your Broker, begins this part by revealing one of the most important lessons in constructing a portfolio. While brokers and financial advisors can be helpful, their interests are not always aligned with yours. Understanding this reality is the first step in taking control of your investments and keeping more of your hard-earned money working for you. Chapter 7. The Enemy is Your Broker. Many investors assume that brokers and financial advisors are their friends, working to grow their wealth. John Bogle warned that this assumption is often dangerous. Brokers are salespeople. Their goal is to earn commissions, fees, or bonuses, not necessarily to maximize your returns. Understanding this reality is one of the most important steps toward taking control of your investments. Bogleheads view brokers not as allies, but as service providers whose incentives may conflict with yours. Every trade, fund recommendation, or financial product they suggest may include hidden costs or conflicts of interest. High commissions, front-end or back-end loads on mutual funds, and frequent trading are all ways brokers profit from your activity. The more you trade, the more they earn, regardless of whether your portfolio grows. This does not mean all financial professionals are bad, but it does mean that you must approach advice with caution and skepticism. Always ask, who benefits from this recommendation? Is there a simpler, lower-cost alternative? Often, index funds or ETFs purchased directly through a low-cost platform outperform high-fee products promoted by brokers over time. Another important lesson is the danger of complexity. Brokers may encourage strategies that sound sophisticated: market timing, sector rotation, or exotic products promising higher returns. These may appeal to emotions or ego, but history shows that simple, low-cost strategies consistently outperform complex approaches. Complexity often hides fees and risks that quietly erode wealth. Bogleheads also emphasize self-education. By learning the principles of investing, you reduce dependence on brokers and protect yourself from costly mistakes. Knowledge empowers you to make informed decisions, choose low-cost funds, and avoid unnecessary trading. It is the key to building a portfolio that aligns with your goals, not someone else's profit motives. One practical step is to compare costs carefully. Every dollar spent on fees is a dollar that will not grow with compounding. By minimizing fees, you keep more of your money working for you. Low-cost index funds and ETFs are the Boglehead's weapon against high-cost intermediaries. Over decades, small differences in cost compound into substantial wealth advantages. Finally, remember that investing is long-term. Brokers may encourage frequent changes or panic-based decisions, but your goal is stability and growth. By controlling costs, avoiding unnecessary trades, and focusing on what you can influence, you gain power over your financial future. With this understanding, the next logical step is learning how to keep your costs low. In the following chapter, we explore practical strategies to reduce expenses, maximize compounding, and ensure that your portfolio works efficiently toward your long-term goals. Chapter 8. Keep your costs low. One of the simplest yet most powerful rules in investing is also the most overlooked. Keep your costs low. John Bogle repeatedly emphasized that high costs are the silent killer of wealth. Every extra fee, commission, or expense erodes your returns over time, and the impact compounds just like your gains. Even seemingly small differences in costs can lead to significant differences in wealth decades later. Investors often focus on picking the best fund or the next market opportunity while ignoring fees. This is a critical mistake. A fund that promises high returns but charges high fees often underperforms a low-cost index fund over the long term. Bogleheads believe that controlling costs is one of the few things an investor can reliably influence. Market outcomes are uncertain, but fees are not. Keeping costs low is a predictable way to improve your results. There are several types of costs to watch: mutual fund expenses, trading commissions, management fees, and hidden administrative charges all add up. Front-end loads, back-end loads, and 12b-1 fees can quietly reduce your returns without your awareness. Even advisory fees matter. By choosing low-cost funds, using discount brokerage accounts, and minimizing unnecessary trades, you allow your investments to grow without leakage. Simplicity plays a crucial role in cost management. A straightforward portfolio of a few index funds or ETFs often outperforms a complex, high-fee portfolio. Complexity adds not only costs but confusion. Every new fund, every frequent trade, every elaborate strategy increases the likelihood of mistakes and drains wealth. Bogleheads focus on long-term growth through low-cost, broadly diversified funds rather than chasing market trends. The impact of fees becomes more dramatic over time because of compounding. Imagine paying 1% more in annual fees. It may not seem like much today, but over decades, this small difference can erase a large portion of your wealth. Every dollar saved on costs is a dollar that continues to earn returns year after year. This is why minimizing expenses is considered the most reliable way to increase your net returns. Another lesson is to be wary of advice that comes with hidden costs. Many brokers, advisors, or marketing materials may recommend products with high fees under the guise of expertise or active management. Knowledgeable investors question these recommendations and compare them against low-cost alternatives. Transparency and awareness are key. Finally, keeping costs low is not just a technical matter. It is a mindset. It teaches discipline, patience, and respect for long-term results. By focusing on what you can control, your costs, your allocations, and your behavior, you gain an advantage that no market prediction can replace. Once you understand the importance of costs, the next chapter, Taxes Matter, will show how to further protect your returns. Taxes are another silent force that can reduce wealth, and by planning carefully, you can ensure that more of your money stays invested and continues to grow over time. Chapter 9. Taxes Matter. Taxes are one of the few guarantees in life, and for investors, they are a hidden force that can quietly erode your wealth. John Bogle and the Bogleheads remind us that while you cannot control the market, you can control how much of your investment gains the government keeps. Paying attention to taxes is not about avoiding responsibility. It is about planning wisely so that your money continues to work for you. Investment taxes come in many forms: income tax on interest, capital gains tax on profits, and taxes on dividends. Even small differences in tax treatment can make a big impact over decades. A portfolio that ignores tax efficiency may appear to perform well, but after taxes, its growth may be much lower than a well-planned alternative. Understanding these rules and structuring your investments accordingly is a critical part of long-term wealth building. One of the most powerful tools for tax efficiency is choosing the right account. Retirement accounts, such as IRAs, 401ks, or similar tax-advantaged vehicles, allow your money to grow without immediate taxation. Contributions may reduce taxable income today, and earnings compound tax-deferred until withdrawal. This deferral can make a substantial difference over time, especially when combined with low-cost, broadly diversified funds. Asset location is another key strategy. Placing tax-inefficient investments, like bonds that generate interest, in tax-deferred accounts, while keeping tax-efficient investments, like index funds or ETFs, in taxable accounts reduces your overall tax burden. This careful planning ensures that more of your money remains invested and compounding, rather than being lost to taxes. Timing also matters. Selling investments triggers capital gains taxes. Long-term gains are usually taxed at lower rates than short-term gains, which rewards patience. Frequent trading not only increases costs, but also increases taxable events, reducing net returns. The Boglehead approach encourages a buy and hold strategy, minimizing unnecessary transactions and letting the power of compounding work uninterrupted. Taxes also influence asset allocation decisions. For example, municipal bonds may offer tax-free interest, which can be advantageous in certain taxable accounts. Understanding these nuances allows investors to structure a portfolio that grows efficiently after taxes, not just before. Small adjustments in tax planning can yield large differences over decades. Finally, taxes are a reminder that investing is about long-term thinking. Short-term gains may feel exciting, but strategic, tax-conscious decisions create lasting wealth. By combining low costs, proper asset allocation, and tax efficiency, you ensure that your investments grow steadily, quietly, and reliably. With taxes accounted for, the next critical step is deciding the proper mix of assets in your portfolio. In the next chapter, Asset Allocation. The most important decision. You will learn how dividing your investments between stocks, bonds, and other assets balances risk and return, setting the foundation for long-term success. Chapter 10. Asset Allocation, the most important decision. Asset allocation is the cornerstone of a successful portfolio. John Bogle often said that choosing the right mix of assets is far more important than picking individual stocks or trying to time the market. It determines your potential for growth, your level of risk, and your ability to stay invested through market ups and downs. In simple terms, asset allocation decides how much of your portfolio goes into stocks, bonds, and other investments. Stocks offer growth, but come with volatility. They are the engine that drives long-term wealth, but their prices can fluctuate sharply in the short term. Bonds provide stability, income, and protection against market swings, but their returns are generally lower. Cash and short-term investments offer safety but minimal growth. Each asset class has a role, and combining them wisely balances reward and risk. The right allocation depends on your goals, time horizon, and risk tolerance. Younger investors with decades until retirement can afford a higher proportion of stocks, accepting short-term ups and downs for greater long-term growth. Older investors, nearing retirement, typically shift toward bonds and safer assets to protect accumulated wealth and reduce the risk of large losses that could derail their plans. Diversification is a key principle in asset allocation. By spreading investments across asset classes, industries, and geographic regions, you reduce the impact of any single event on your portfolio. A diversified portfolio can withstand market shocks, as declines in one area are often offset by gains or stability in another. This is not speculation, it is risk management. Rebalancing is closely linked to allocation. Over time, market movements can skew your portfolio away from your desired mix. Stocks may rise sharply while bonds lag, increasing your risk beyond your comfort level. Periodically rebalancing your portfolio, selling some of what has grown and buying what has lagged, restores the intended balance, maintaining your risk profile and keeping your plan on track. Asset allocation also interacts with other important factors like taxes and costs. Choosing low-cost index funds for each asset class reduces fees, while considering tax-efficient placement of assets maximizes after-tax returns. The combination of proper allocation, low costs, and tax awareness dramatically increases your chance of long-term success. Ultimately, asset allocation is a personal decision, not a universal formula. It reflects your goals, comfort with risk, and time horizon. While the market is unpredictable, the allocation you choose today sets the framework for steady growth, allowing you to navigate volatility without panic. It is the single most important decision in constructing a portfolio because it determines both the potential for reward and the ability to endure market swings. With a clear understanding of asset allocation, the next step is choosing the right tools to implement it. In the next chapter, How to Choose an Index Fund, you will learn how to select investments that match your allocation, minimize costs, and provide broad market exposure, turning your plan into action. Chapter 11. How to Choose an Index Fund. Index funds are at the heart of the Boglehead philosophy. They are simple, low-cost, and transparent, offering investors a way to participate in the entire market without trying to pick winners and losers. John Bogle pioneered this approach because he understood a fundamental truth. Most active managers fail to beat the market over time, and high fees erode returns. An index fund solves both problems, providing market returns at minimal cost. Choosing the right index fund begins with understanding what it tracks. Some funds follow the entire stock market, while others track specific sectors, international markets, or bonds. Your choice should align with your asset allocation plan. For example, if you have decided that 30% of your portfolio should be in bonds, choose a bond index fund that represents a broad, diversified segment of the bond market. Simplicity is key. Avoid overly specialized or complex funds that promise higher returns but carry additional risks or costs. Cost is the next critical factor. Expense ratios matter more than past performance. A lower cost fund allows more of your money to remain invested and benefit from compounding. Even a small difference in expenses can significantly impact wealth over decades. Bogleheads emphasize choosing funds with transparent, predictable costs rather than chasing flashy returns or market hype. Tracking error is another consideration. Ideally, an index fund should closely match the performance of the market it tracks. Small deviations are normal, but consistent underperformance may indicate inefficiency or management issues. Look for funds with a history of accurately tracking their index over time. This ensures that your portfolio behaves as expected, reflecting your intended asset allocation. Liquidity and accessibility are practical but important aspects. Make sure the fund is easy to buy, hold, and sell through your brokerage or retirement account. Avoid funds with complex purchase rules or high minimum investment requirements, especially if you are just starting out. Ease of use encourages consistent investing and reduces the temptation to make emotional decisions. Diversification within the fund is also essential. A broad index fund spreads investments across many companies or bonds, reducing the impact of any single failure. This is the foundation of risk management in the Boglehead approach. Don't put all your eggs in one basket, and let the market itself do the work of spreading risk. Finally, stay the course. Once you have selected the right index funds for your allocation, resist the urge to switch frequently. Markets fluctuate, and news cycles create anxiety, but long-term consistency is far more powerful than chasing short-term gains. Your funds will grow steadily if held over time, faithfully reflecting your allocation plan. With your index fund selected, the next chapter, Mutual Funds versus ETFs, explores the differences between these two popular investment vehicles. You will learn how to choose the structure that fits your goals, trading style, and cost considerations, while keeping your portfolio aligned with the Boglehead principles of simplicity and efficiency. Chapter 12. Mutual Funds versus ETFs. Once you understand the power of index investing, the next decision is choosing the investment vehicle. Two of the most popular options are mutual funds and exchange-traded funds, or ETFs. Both offer the benefits of diversification, low costs, and access to broad markets, but they have important differences that can affect your strategy, convenience, and overall returns. Mutual funds have been around for decades. They pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. They are priced once a day, and purchases or sales occur at the net asset value, or NAV, after the market closes. Mutual funds are straightforward, often allowing automatic contributions, dividend reinvestment, and professional management. They are simple to use, especially for investors who prefer a set-it-and-forget-it approach. ETFs, on the other hand, trade like stocks on an exchange. Their price changes throughout the day, and they can be bought or sold at market prices anytime the market is open. ETFs often have lower expense ratios than comparable mutual funds, and they offer flexibility in trading strategies. They can also be more tax efficient, as the creation and redemption process reduces capital gains distributions. Cost is a critical factor in this decision. Bogleheads prioritize keeping costs low because fees compound against your wealth over time. While both mutual funds and ETFs can be low cost, ETFs generally offer slightly lower expenses. However, investors must account for trading commissions if their brokerage charges fees for buying and selling ETFs. For long-term investors with a buy and hold mindset, these costs are usually minimal, but they should still be considered. Tax efficiency is another important difference. Mutual funds often distribute capital gains to investors, which can create a tax liability even if you do not sell shares. ETFs, because of their structure, usually generate fewer taxable events, helping you keep more of your returns over time. This makes ETFs particularly appealing for taxable accounts, while mutual funds remain convenient for tax-advantaged accounts like IRAs and 401ks. Convenience and automation also matter. Mutual funds allow easy automatic investing, reinvestment, and account management. ETFs require a brokerage account and more manual steps, which may be less convenient for some investors. Choosing between the two depends on your priorities: cost and tax efficiency versus convenience and automation. Ultimately, both vehicles achieve the same goal: broad market exposure at low cost. The Boglehead philosophy emphasizes that the specific vehicle is less important than maintaining consistency, simplicity, and adherence to your asset allocation plan. Avoid overcomplicating your choices and focus on staying invested in a diversified, low-cost portfolio. The next step in portfolio construction is rebalancing, staying on course. Even with low-cost funds and proper allocation, market movements can shift your portfolio away from your target. Rebalancing ensures your plan remains aligned with your goals, risk tolerance, and long-term strategy. Chapter 13. Rebalancing, staying on course. Even the best constructed portfolio does not remain perfectly balanced on its own. Stocks rise and fall, bonds fluctuate, and market events shift the value of your investments. Over time, these changes can distort your asset allocation, exposing you to more risk than intended, or reducing potential growth. This is why rebalancing is essential. It keeps your portfolio aligned with your long-term plan. Rebalancing is the disciplined practice of restoring your portfolio to its target allocation. For example, if your plan calls for 70% stocks and 30% bonds, but stocks have surged and now comprise 80% of your portfolio, you would sell a portion of stocks and buy bonds to return to the original balance. Conversely, if stocks fall and their share drops, you would buy more stocks and sell some bonds to maintain alignment. The goal is not to predict market movements, but to maintain a consistent risk profile. Many investors avoid rebalancing because it feels counterintuitive. Selling winners and buying laggards seems unnatural. Humans prefer to chase trends rather than act against them. But this discipline is what separates successful investors from those who react emotionally. Rebalancing enforces the principle of buy low, sell high automatically, without the need for timing the market or making speculative decisions. The frequency of rebalancing depends on your situation. Some Bogleheads rebalance annually, while others use thresholds, adjusting only when allocations drift beyond a set percentage. The key is consistency. Overly frequent adjustments create unnecessary costs and taxes, while neglecting rebalancing allows risk to grow unnoticed. Find a schedule that balances efficiency with maintaining the desired allocation. Rebalancing also provides an opportunity to review your portfolio as your life changes. Goals, time horizons, and risk tolerance evolve. Periodic reviews let you adjust allocations, incorporate new investments, and ensure that your plan reflects your current reality. It is both a financial and psychological tool, reinforcing discipline and focus. Importantly, rebalancing is not about chasing returns. It is about controlling risk. By returning your portfolio to the intended mix, you maintain a predictable exposure to stocks, bonds, and other assets, helping you sleep at night even during volatile markets. This steadiness is the backbone of long-term investing success. Once your portfolio is balanced and aligned with your goals, the next step is applying these principles to life's biggest investment horizon: retirement. In Part 3, Winning Strategies for Long-Term Success, we move beyond constructing your portfolio to planning for the future. The next chapter, The Boglehead's Guide to Retirement Planning, will show how to use your disciplined habits, diversified investments, and careful planning to secure financial independence and peace of mind for the decades ahead. Chapter 14, The Boglehead's Guide to Retirement Planning. Retirement planning is the ultimate goal for most investors. It is the stage where the disciplined habits you've built over decades pay off, and where your investments must support your lifestyle without creating stress or risk of running out of money. John Bogle emphasized that retirement planning is less about complex calculations and more about thoughtful, consistent decisions over time. The first principle is to define your retirement goals clearly. How much income will you need? What kind of lifestyle do you envision? Consider housing, travel, healthcare, and daily living expenses. Understanding these needs allows you to determine how much to save and invest each month. Ambiguity leads to underfunding or overspending, while clarity gives direction and confidence. Starting early is critical, as we learned in earlier chapters. The power of compounding accelerates over decades, so even modest contributions in your 20s or 30s can grow into substantial retirement savings. Automatic, consistent investing ensures that you stay on track without needing to time the market or make frequent adjustments. Asset allocation remains central in retirement planning. Younger investors may prioritize growth through a higher stock allocation, while those closer to retirement gradually shift toward bonds and other stable investments to protect accumulated wealth. This glide path ensures that risk decreases as the need for capital preservation increases, balancing growth with security. Taxes and account types play a vital role. Tax-advantaged accounts like 401ks, IRAs, or equivalents allow your money to grow without immediate taxation, increasing your effective returns. Knowing which assets belong in taxable versus tax-deferred accounts can maximize after-tax wealth. Bogleheads carefully plan withdrawals to minimize tax impact, taking advantage of the most efficient order of distributions. Another key principle is keeping costs low. High fees during retirement reduce the income available for living expenses. Index funds, ETFs, and low-cost bond funds remain critical, as every percentage point saved in fees directly increases the money available to support your lifestyle. Discipline does not end at retirement. It becomes even more important when your portfolio supports your daily needs. Withdrawal strategy is equally important. Retirees must balance drawing income with preserving principal. A common approach is the safe withdrawal rate, often around 4% per year, adjusted for inflation. This strategy allows your portfolio to continue growing while providing predictable income. Flexibility and ongoing monitoring ensure that spending adjusts to market conditions without panic or overreaction. Finally, retirement planning is not just about money. It is about peace of mind and freedom. Bogleheads emphasize that disciplined investing, low costs, and long-term planning reduce stress and create the freedom to enjoy retirement without constant worry about markets or financial crises. With retirement planning in place, the next challenge is avoiding common mistakes. In the following chapter, Common Mistakes and How to Avoid Them, we explore the behavioral traps, missteps, and overlooked errors that can derail even disciplined investors, and how to stay focused on your long-term success. Chapter 15. Common Mistakes and How to Avoid Them. Even the most disciplined investors can fall into traps that slowly erode wealth over time. John Bogle often highlighted that mistakes, not market performance, are the primary cause of investment failure. Understanding common pitfalls and learning how to avoid them is essential to staying on the path of long-term success. One of the most frequent mistakes is chasing performance. Investors are often tempted to buy funds or stocks that have performed exceptionally well recently, hoping the trend continues. This behavior is driven by greed and fear of missing out. Unfortunately, past performance rarely predicts future returns, and high-performing investments often come with higher risk or fees. Bogleheads focus on long-term strategy rather than short-term gains, sticking to diversified, low-cost index funds. Another common error is failing to maintain proper asset allocation. Over time, market movements can shift your portfolio, exposing you to more risk than intended. Some investors ignore this drift, while others overreact to short-term fluctuations. Both approaches can be costly. Regular rebalancing ensures your portfolio remains aligned with your goals, controlling risk while maintaining growth potential. High costs are another silent enemy. Investors may chase managed funds or complex strategies without realizing the fees they pay. Front-end loads, back-end loads, expense ratios, and trading costs erode returns over decades. Bogleheads avoid this by prioritizing low-cost index funds and minimizing unnecessary trading, keeping more of their money working for them. Behavioral mistakes often have the greatest impact. Emotional reactions to market volatility, panic selling during downturns, or overbuying during booms can devastate long-term wealth. Overconfidence, procrastination, and lack of discipline compound these errors. Developing a calm, rational mindset, focusing on the long term, and ignoring market noise are crucial skills for every investor. Timing the market is another trap. Many try to buy low and sell high, but accurately predicting market movements is nearly impossible. Those who attempt it often miss the best days of market returns or sell during temporary declines. Consistent, regular investing with a long-term perspective outperforms short-term speculation in almost every scenario. Failing to plan for taxes is a common oversight. Ignoring tax efficiency reduces net returns and compounds losses over decades. Bogleheads carefully manage taxable and tax-advantaged accounts, choosing investments and withdrawal strategies that minimize tax impact and maximize after-tax growth. Finally, neglecting retirement and long-term goals is a subtle but dangerous mistake. Without a clear plan, investors may save too little, take inappropriate risks, or spend prematurely. Setting clear goals, adhering to a disciplined plan, and adjusting over time ensures that your portfolio grows steadily toward your objectives. Understanding these common mistakes leads naturally to the next chapter, Behavior, the investor's worst enemy. Here, we explore the psychological aspects of investing, showing how emotions, biases, and mental traps can sabotage even the best plans, and how disciplined Boglehead strategies protect you from them. Chapter 16. Behavior, the investor's worst enemy. Investing is not just about numbers, strategies, or market knowledge. John Bogle often emphasized that the biggest obstacle to financial success is human behavior itself. Fear, greed, overconfidence, and impatience can destroy even the most carefully constructed portfolio. Understanding your own psychology is just as important as understanding the market. One of the most destructive behaviors is emotional decision-making. Investors tend to react to market fluctuations instead of sticking to a long-term plan. During a market crash, fear can trigger panic selling, locking in losses that would have recovered over time. During booms, greed can drive overinvestment in high-flying assets, often at their most expensive prices. Bogleheads counter this by maintaining discipline, focusing on their long-term goals rather than daily market noise. Overconfidence is another trap. Many investors believe they can outperform the market or pick the next big winner. This confidence often leads to excessive trading, high fees, and poor performance. History shows that most active managers fail to beat simple index funds over decades. Accepting market returns and focusing on factors you can control, costs, allocation, and behavior, is far more effective. Procrastination is equally damaging. Delaying investing, ignoring portfolio reviews, or failing to plan for retirement reduces the compounding potential of your money. Every year you wait is lost growth that cannot be recovered. Bogleheads stress the importance of starting early, contributing consistently, and reviewing your plan periodically to stay on course. Herd mentality is another behavioral challenge. Investors are influenced by media hype, peer pressure, or market trends. Buying high during bubbles and selling low during crashes is often the result. Discipline, education, and adherence to a proven plan help counter this instinct, allowing investors to act rationally when others act emotionally. Anchoring and recency bias also affect decisions. Investors may overvalue recent events or fixate on historical highs and lows. This skews perception and leads to irrational choices. Bogleheads rely on data, diversification, and a long-term strategy rather than being swayed by headlines or short-term performance. Patience and simplicity are key antidotes to behavioral mistakes. By keeping a clear plan, maintaining low-cost, diversified investments, and rebalancing periodically, you reduce the influence of emotions. A well-designed portfolio and disciplined behavior work together to ensure consistent growth and risk management. Understanding behavior prepares you for the next principle: the power of simplicity. In the following chapter, you will learn why simplicity is not just convenient, but a strategic advantage. A simple, low-cost, diversified approach reduces errors, keeps costs down, and allows you to focus on what truly matters for long-term investing success. Chapter 17: The Power of Simplicity. Simplicity is more than a convenience in investing. It is a powerful strategy. John Bogle consistently emphasized that the simplest approaches often produce the best long-term results. Complexity may feel impressive, but it often hides risks, increases costs, and encourages mistakes. A clear, straightforward plan allows you to focus on what truly matters: staying invested, minimizing fees, and maintaining discipline. A simple portfolio is easier to understand, monitor, and maintain. When you know exactly what you own and why, you are less likely to panic during market swings or chase short-term trends. Complexity, on the other hand, can create confusion and indecision. Too many funds, complicated strategies, or frequent trading can overwhelm even experienced investors, leading to mistakes that reduce returns. Simplicity eliminates unnecessary noise and keeps your plan focused on your long-term goals. Low costs and broad diversification are central to simplicity. A few well-chosen index funds can provide exposure to the entire market, reducing the need for dozens of individual stocks or niche funds. This approach minimizes fees, maximizes efficiency, and maintains the balance and risk profile you designed through asset allocation. Simplicity does not mean sacrificing returns. It means capturing market growth efficiently. Behavioral benefits also flow from simplicity. When your investments are straightforward, it is easier to remain disciplined. You are less likely to be influenced by media hype, market volatility, or the advice of self-interested parties. By reducing the number of decisions you must make, simplicity helps you focus on consistent saving, rebalancing, and long-term planning. Simplicity extends to retirement planning as well. Clear goals, consistent contributions, and a diversified, low-cost portfolio make it easier to estimate future income, manage withdrawals, and adjust for life changes. Complicated strategies may promise higher returns, but often increase risk and anxiety. A simple, disciplined approach provides both financial security and peace of mind. Finally, simplicity reinforces the Boglehead philosophy of control. You cannot control the market, interest rates, or economic cycles, but you can control your choices, costs, and behavior. Focusing on these controllable factors through simple, disciplined investing increases your odds of long-term success while reducing stress and unnecessary risk. Once simplicity is embraced, there comes a time when advice may be necessary. In the next chapter, When You Need Advice, we explore the role of professional guidance in investing. You will learn when advice adds value, how to choose advisors wisely, and how to avoid conflicts of interest, ensuring your plan remains consistent, efficient, and aligned with your long-term goals. This naturally leads to staying on course for life's most important financial journey. Chapter 18. When You Need Advice. Even disciplined, knowledgeable investors sometimes need guidance. While the Boglehead philosophy emphasizes self-education, simplicity, and low-cost investing, there are situations where professional advice can add value. The key is understanding when advice is truly necessary, how to select it wisely, and how to avoid pitfalls that can erode returns or compromise your plan. One common scenario for seeking advice is during major life events. Marriage, divorce, inheritance, job changes, or retirement planning often require expertise beyond basic investing knowledge. Advisors can help structure portfolios, optimize taxes, and create a comprehensive financial plan that accounts for personal circumstances. In these cases, guidance helps avoid costly mistakes and ensures long-term goals remain achievable. Another situation is complex financial decisions. Estate planning, tax-efficient strategies, insurance selection, and corporate stock options may be difficult to manage alone. A competent, ethical advisor provides clarity, education, and actionable recommendations. The goal is not to rely blindly on advice, but to use it as a tool to make informed decisions and maintain control over your finances. Choosing an advisor wisely is crucial. Bogleheads emphasize aligning incentives. Avoid advisors who earn commissions or push products that generate profits for themselves. Fee-only fiduciaries, who are legally obligated to act in your best interest, are generally the most reliable. Transparency, simplicity, and clear communication are essential criteria when selecting professional guidance. Even when working with an advisor, it is important to remain engaged. Understand your portfolio, question recommendations, and verify costs and risks. Knowledge protects you from being misled and ensures your investments continue to align with your goals. Advice should empower, not replace your decision-making. Another key principle is knowing when advice is unnecessary. Many investors pay for guidance they could easily provide themselves. Index funds, low-cost ETFs, basic asset allocation, and automatic rebalancing do not require expensive consultations. Overcomplicating a simple plan often introduces costs, confusion, and mistakes. The Boglehead approach values advice that truly adds value, not advice that promotes activity or complexity. Finally, seeking advice should complement, not override, the principles of discipline, low costs, and long-term investing. Professional guidance can enhance understanding, provide reassurance, and assist in complex scenarios, but it should never replace the core practices that drive long-term success. Knowledge, patience, and consistency remain the foundation. With or without advice, the ultimate goal is to stay the course. In the epilogue, Stay the Course, we consolidate these lessons, emphasizing the power of consistency, patience, and disciplined investing. Staying committed to a well-designed plan, avoiding emotional reactions, and maintaining focus on long-term goals are the keys to achieving financial independence and lasting wealth. Epilogue. Stay the course. The most important lesson from John Bogle and the Bogleheads is simple. Stay the course. Markets will rise and fall. Economies will experience booms and busts, and headlines will create fear or excitement. Yet, long-term success is determined not by predicting the next market move, but by remaining disciplined, patient, and consistent over decades. Staying the course means adhering to your asset allocation, holding low-cost, diversified investments, and avoiding the temptation to chase performance or react emotionally. It means trusting in the power of compounding, the reliability of markets over time, and the value of simplicity. Your behavior, more than the market, determines your results. It also requires resisting short-term distractions. Media hype, financial gurus, and sudden market swings can tempt investors to deviate from their plan. Panic selling during declines or buying into bubbles can permanently harm long-term wealth. Bogleheads focus on what they can control: costs, allocation, diversification, and behavior. Everything else is noise. Discipline is reinforced by regular investing and rebalancing. By contributing consistently, taking advantage of tax-advantaged accounts, and periodically restoring your portfolio to its target allocation, you maintain both growth potential and risk control. This steady approach allows your investments to grow predictably, even when the market seems chaotic. Patience is equally essential. The greatest rewards in investing come to those who endure, who give their money time to compound, and who resist the urge for quick gains. Decades of disciplined investing, even with modest contributions, can create wealth far beyond what emotional or short-term strategies achieve. Finally, staying the course is a mindset. It is about trusting in proven principles, focusing on controllable factors, and avoiding distractions that lead to mistakes. By committing to simplicity, low costs, diversification, and rational behavior, you empower yourself to achieve financial independence, security, and peace of mind. The journey of investing is long, but following these principles ensures that your portfolio works for you, steadily growing toward your goals. Remember that every decision, from choosing low-cost index funds to managing emotions during market volatility, builds the foundation for long-term success. With the course set, investors can move confidently into the future, equipped with the knowledge, discipline, and strategies necessary to achieve lasting wealth and financial freedom. The next sections, Appendix, Boglehead Resources and Acknowledgements, provide additional tools, references, and recognition of those who contributed to this guide, ensuring that your journey continues with support and guidance. Appendix, Boglehead Resources. The Boglehead philosophy is built not just on principles, but also on a wealth of resources to guide investors. These tools, communities, and references provide education, support, and practical advice to help you implement the strategies outlined in this book effectively. One of the most valuable resources is the Bogleheads.org community. This online forum connects thousands of investors worldwide who share experiences, strategies, and advice. It is a place to ask questions, read case studies, and learn from both successes and mistakes. The community emphasizes long-term investing, low costs, diversification, and disciplined behavior, reinforcing the core principles of the Boglehead approach. Books and guides are another essential resource. In addition to this book, many other publications explain index investing, asset allocation, tax-efficient strategies, and retirement planning. Recommended readings include John Bogle's own works, which provide deep insights into investing philosophy, fund selection, and the history of index funds. These texts allow investors to study successful strategies and understand the rationale behind them. Software and online tools help investors track portfolios, calculate asset allocation, and plan retirement goals. Many free and low-cost platforms exist to monitor investments, simulate scenarios, and analyze risk. These tools make it easier to implement strategies, rebalance portfolios, and measure progress toward long-term goals. By using technology, you can maintain discipline and clarity without unnecessary complexity. Newsletters and blogs from reputable sources provide ongoing education and updates on market trends, fund performance, and regulatory changes. While short-term news should never dictate your investment strategy, these resources help investors stay informed and make better decisions regarding taxes, account types, and other practical matters. Workshops, seminars, and webinars offer opportunities to learn directly from experts and experienced Bogleheads. Many are free or low cost and provide step-by-step guidance on portfolio construction, retirement planning, and behavioral investing. Participating in these events strengthens understanding, builds confidence, and encourages disciplined, informed investing. Finally, financial calculators and planning templates are invaluable for long-term strategy. Tools for estimating retirement needs, safe withdrawal rates, and tax-efficient investment allocations allow you to plan systematically. These resources turn abstract principles into actionable steps, ensuring your portfolio aligns with goals and risk tolerance. By using these resources, investors can continue learning, refining their approach, and staying committed to the Boglehead principles. Knowledge, community support, and practical tools reinforce discipline, reduce errors, and increase the likelihood of long-term success. The appendix ensures that your journey does not end with this book. With guidance, community, and tools, you are equipped to stay the course, manage your portfolio wisely, and build lasting wealth.